Hello, everyone. We're beginning now. Sorry that we had a few little technical difficulties, but I think we're beginning. Hi, this is Dan Timins. I'm talking to you today from my apartment in New York City, and we are continuing with our series regarding life insurance, what you need to know. Our speaker today is Stephen Cohen. Stephen is not just a professional who I've worked with a good deal. He is a friend and a colleague of mine. And I have nothing but great things to say about him. Stephen has been working with me since I think my last marriage. That's how long it's been. But I'm happily married this time around. Unfortunately, he doesn't have to listen to me complain anymore about that one. Stephen is a certified financial planner as well as being an attorney, so he and I get to share that in common. And I've been fortunate to work with him with many of his clients. He's worked with my clients. Him and his partner, Michael Luffman, have just been wonderful. And everyone I've ever worked with who's worked with them or my clients I've sent to them, every single one has been happy. And I can't blame them. I've been happy with them as well. Can't think of a better guy as well. So today, for a very expansive discussion, we are bringing on Stephen Cohen. Hey, Stephen. Thank you for joining us today.
Thanks, Dan.
And without further ado, I leave this to you.
Thank you, Dan, and welcome everyone. I really appreciate the opportunity to speak before your clients, Dan. If you could go to the first screen, please. Okay, so today we're going to talk about something very simple, but we're going to look at more complex ways of utilizing life insurance. Everybody knows about insurance. Everybody's had some policies at some point in their life. The biggest thing I find out when I meet with new clients is they don't really know much about it. They're not quite sure how much they have. They don't know what the particulars provide. They don't know what happens if they leave their employment, how long the coverage stays. Is it permanent or temporary? So Dan and I thought that it might be a really good thing to take an in-depth, detailed dive into life insurance and its applications. And most notably at the end, we're going to talk about the combination of life insurance and long-term care, the hybrid plan. And the hybrid plan is a very unique way of covering two needs. So the next slide, Dan. So what is life insurance? Typically, everybody knows it's a financial product that provides a death benefit, identified beneficiaries upon the death of insured. Simply put, life insurance provides a level of financial protection for your loved ones. That's a very easy philosophy. I'm doing this for 32 years. I've never had one beneficiary said to me that I'm really upset with my spouse or my partner or my business partner because they didn't have enough coverage, you know, that they had too much coverage. It's always that I wish they would have had more. I wish I would have understand it. People always say, oh, they had so much coverage. I was really well prepared. No one gets upset when that's the case. It's always the reverse. So next slide, Dan. So basically, an insurance death benefit may be used to help your loved ones cover income replacement, debt elimination, or paying for future expenses. So first thing, life insurance is always income tax-free, the death benefit, always tax-free. There's very few circumstances where you can make the tax-free benefit taxable. That's where you have more than two parties to a contract. So if Dan were the owner of my contract, I was the insured, and my wife was the beneficiary, when my wife received the money, that money would be taxable instead of tax-free. So the first thing we do when we meet with people, we want to make sure that their policies are still providing a tax-free benefit. The second thing we want to do is we want to look at what the need's for. Everybody knows the basic premise that life insurance should pay off debt, it should provide a lost income, and it should do other things that you want it to do. The biggest problem I find is that people don't think about what the life insurance needs are for. They'll say, okay, it's 10 times your salary, or it's this amount. What we want to do is we want to know that if something happens to a person, do you want the mortgage to be paid off? Do you want the credit card to be paid off? Do you want other debt? And let's assume that everything's paid off. Do you want to make sure your kids go to college? Do you want to do it for all 4 years? Do you want to provide for grad school? And then let's assume you do that. Let's assume the debt's paid off and the education's funded. Then what about lost income? You're still going to need an income. You're still going to need to replace part of your income. It may not be as much as when you had your debt and you had the burden of educating children, but there has to be some amount. One thing that most people forget, Dan, is that when you're getting Social Security, let's say you're a married couple and you're both getting paid Social Security benefits, when one person dies, the other person steps into that person's Social Security benefit if it's higher, but you lose the second benefit. So while two people are alive getting Social Security, one person dies, you lose the second benefit. So if you're getting $1,500 a month from that second Social Security, now you lost $18,000 a year. Over 20 years is $360,000. A lot of people don't think of it. A lot of people say, okay, at that point in my life, I don't think I need life insurance anymore, but I'm just broaching that topic to let you know that life insurance doesn't stop all the time when you get to be 50 and 60 and 65. Sometimes it may continue forever.
And just to tack onto that, Stephen, a lot of clients that I have met with have let their life insurance lapse or have made it to the point where their kids are in college and they say, I don't need life insurance. When the first one of them passes away in retirement age, they could be in their mid-late 70s. Their spouse typically lives into their 90s. So that, like you said, is 20 years without having that additional asset available.
Right. And a lot of times what happens, Dan, is they buy the type of coverage, they don't buy the amount. It's life insurance, predominantly life insurance protection. It doesn't have to be expensive. Obviously it's based on your medical conditions and exams and doctor's report, but assuming you're healthy, you listen to the commercials on television and radio, they're not expensive. The ones that are expensive are the ones where you have other needs attached to it. So if your goal is to make sure the kids go to college, the debt's paid off, the mortgage is funded, then it doesn't have to necessarily be a very expensive item. Okay, Dan? So there are two types of coverages. One is term and the other one is permanent. Term is exactly how the name sounds. You buy insurance for a term, a period certain. It could be a 10-year period, could be a 20-year period, could be a 30-year period. At the end of that period of time, your policy expires. So in my career doing this as many years as I have, there are many, many times that my clients have talked me into letting them take a lesser or shorter payment period. So they'll say, I only need it for 15 years. We'll do 15 years. And 15 years later, we get back together and I say, why did we do 15 years? And they said, I don't know. Why did we do it? Because it sounds like a very long period of time 15 years ago. But that's what it's for. It's for a set duration. At the end of that period of time, if you're still alive, luckily, then either you'll need to renew it at that point and go through a full range of underwriting, or you're going to let it expire. Only 4% of people ever die with term insurance. Only 4%. The rest of it have their insurances lapse or they terminate it. The second type of plan is a permanent plan. And a permanent plan could be different things for different people. For example, some of the permanent plans build up cash. The cash builds up tax deferred. Or some plans are permanent with no cash value. But remember, no matter which type of plan, the death benefit always tax free. So if you're interested in a permanent plan without cash value, there's a plan for that. If you want a permanent plan where you get tax deferred growth, you pull the money out on a tax advantage basis, there's a plan for that. If you want a plan where it's really inexpensive, where you protect your family and you want to make sure your foundation is laid, there's a plan for that. Okay, Dan? So when we do financial planning, as Dan said, I'm a CFP, certified financial planner. When we do financial planning for people, what's the first thing you do? You build a foundation. What's the foundation? When you're building a home, what's your foundation? It's the foundation is where the home sits on. The same thing with financial planning. Your foundation is to protect your risks, is to protect your dangers. What are your dangers? Your dangers if you die, become disabled, or you lose a job. You become unemployed. You need an emergency fund. That's your foundation. So before you do anything fancy, before you start shorting the market or investing or doing anything, you want to make sure your foundation's in order to make sure your family's protected and to make sure your house is on the right footing. So as I said before, you see the term insurance can last for 10, 15, 20, or 30 years, and the permanent can offer a lifetime of protection and cash accumulation. Now, it doesn't necessarily matter which one you choose. If you choose to do term initially for a particular reason, when at any point in time, you could convert that term to a permanent plan. What do I mean by that? No medical exam. So if you said to me, we're younger, we're starting out, my partner and I own a law firm together, and I'm afraid that if something happens to him, he dies and I'm going to be unprotected, or vice versa. You can do a buy-sell agreement, cover each person. You could do a term insurance. 5 years down the road, you say, you know what, our practice is doing great. We're bringing on tons of clients. Rather than having something that's going to expire in 10 years, I want to do it permanent. And by the way, the government only allows us to put aside a certain amount of money for retirement. I want to put more money away. You can use a whole life policy to supplement your retirement income. So no matter if you have term now, you could convert it even if you're uninsurable. I have a client who unfortunately has cancer. We're reaching the end of her conversion period. If she doesn't convert it now, then she won't be able to get other coverage down the road because now she's deemed uninsurable. But she could always convert it at her rate, at her classification that she had when she first applied for the coverage. So if she were a preferred category, then she could convert it to a preferred category.
Yeah, and something, Stephen, that happens with my clients on occasion. My clients tend to be a little bit older. I have plenty of younger clients as well, but my older clients may be reaching the end of that term period, and something may have happened. You may now be a diabetic, or you may have a health illness of some type, autoimmune, or whatever the case may be, and you just either may A, not be able to get more life insurance, or B, not be able to qualify for any life insurance policy for that matter. And not having to take that physical again is just a great benefit that term policies have.
Good point, Dan. Okay, next slide. So what else can permanent insurance do? It provides cash value accumulation. You could use it for retirement planning, college funding, source of cash or credit. We use it sometimes as a hedge against the market. You look at the market, and it's been very volatile as of late, and you look at whole life. Whole life is basically a permanent plan where the company declares a dividend, and the dividend gets paid to the policyholders. It's not tied to the market. It's not tied to stocks. It's not tied to equities. It's tied to profitability of a particular company. So if a company's paying a dividend currently of 6.1%, that has nothing to do with the market. So oftentimes people say, okay, I have most of my money in the market. I want something that's non-correlated. I want something that's going to be different. So when the market's down 40%, i.e. March, this won't be, I don't want all my assets to be down 40%. So a lot of times people have a whole life where the performance of it is very, very different than most of their money. College funding and also cash or credit. So I spoke to 2 clients recently who they own businesses, and the businesses are having a rough go, and they need to get access to money. And one of their policies has over $250,000 accumulated. And I told her that you can pull out this money, pay it. You don't necessarily have to pay it back. It's up to you. It's completely tax-free, and you could use it any means you want. And they were flabbergasted. Like, she didn't remember us talking about it. She didn't remember the value of it. So she can pull out $90,000, cover payroll, and it's there if you need it. So times like today, where the market's down, it might make sense to pull the income or pull the cash from a different source. Okay, Dan? So what else can it do? Supplement the retirement. We have something called the buffer. What we're finding today is there's something called sequence of returns. So I know we're talking about life insurance and we're talking about the death benefit, and all death benefits are tax-free, but now we're talking about some of the intricacies in a policy. So we know from the prior slides that the cash builds up tax deferred and you take it out tax-free. But the important thing is, when you're doing financial planning and you start taking money out and start living on it, the 2 years immediately preceding your retirement and the 2 years immediately after your retirement, those are the 4 most important years for bad market performance. Why is that? There's something called Monte Carlo simulations. What that basically says is they've ran projections over the past 100 years of every market: up markets, down markets, sideways markets, high interest rates, low interest rates. And they say today that based on where we are, if you pull out a 3% return income off of your assets, you'll have a 90% chance of having your assets go 30 years. If you pull a 4% income stream from the market, you'll have an 82% that your money will go for 30 years. So right now the market's down. If you've agreed on taking 4% of your holdings, let's say you have $2 million and you're pulling out basically $50,000 a year. If the market goes down 30% and your 2 million is now 1.4 million, in order to generate that same income, now you have to take a higher percentage. So you're taking a higher percentage from a lower amount. If you do that a second year and a third year, what's likely to happen? You might run out of money. So when the market's down, can anybody think of another source of income that you can take out that's not tied to the market, that's uncorrelated, and won't come out of a losing investment? That's the cash value of a life insurance. So a lot of our clients, what they've done is they've established these whole life policies with cash value. If their time to retire is now, rather than taking out the money from the market, they take it out from another source. Now, what's the advantage? Well, you look at the market, it was down 40% off its high, and now it's down 15%. So it went down 40% in 3 weeks or 4 weeks, and it went up 25% in 2 weeks. So the nice thing about it is, if you would have taken it out when the market was down 40%, think of how much more return you would have had to have in order to get back to zero. It's a lot more because the market's down. So what we do is we'll recommend using a life insurance policy as a buffer. And the other thing is a source of income. So in the old days, right, let's say Dan says his clients are on the older side. Let's say we had pension plans. I was lucky enough to have a pension plan. People at IBM had pension plans, MetLife had pension plans. So today, most people don't have pension plans. In the old days, what companies would say is, we guarantee that if you stay with us a certain number of years, we're going to give you 50% of your income for as long as your retirement lasts. Doesn't matter. Market crashes, the burden's on the employer. We guarantee it. Today, we don't have defined benefit plans. We have defined contribution plans that basically say is, we're going to allow you to put your money away. We may or may not do a match. Whatever happens to the market is not our responsibility. It's your responsibility. And by the way, if it's not enough money, then you either have to work in retirement or do something different. So what a lot of people do is they say, okay, I'll do the maximum through work, but I'll also do something else as a supplemental retirement income. So I'll do something and I'll put it away. And do I want it equity oriented? Do I want it protected? Do I want it non-correlated, correlated? You can go through an analysis of how you want it.
And Steve, let me ask you a quick question with
Sure.
that. So let's say I'm getting to the point where maybe my kids are doing just fine. I don't need to leave them anything in my, or at least not from the life insurance. I feel like they're going to be just fine without my resources, but I'm a little bit concerned about my income. What happens is I start spending more and more money out of the cash value and I risk that policy just collapsing, not collapsing, but ceasing. What's the tax ramifications of having that policy potentially disappear?
Okay, so first of all, you want to guard against it. So not every plan is designed to allow you to take cash out as income. There are some where you could use the dividends to fund your income and the policy will not collapse and die. If there is a situation where it does, that means you lose your death benefit and you get taxed on any gain you had in the contract. So in a perfect world, you're allowed to take out 90% of the cash value and still keep your policy in force. If you took out 90% and you died the next day, your beneficiaries will get the full death benefit minus whatever you took out already. And that will all be tax-free. If your policy lapses first, then it's liquidated and any of the gain in the policy, you will get a tax statement. So it's in your interest to keep the policy in force. So not every policy is designed to take out the maximum income. Sometimes what you need to do is you need to leave enough income cash in there so that it doesn't expire and it doesn't go to zero. So what we do is if any of you contact me, if we ever met, we would do an in-force illustration. What that basically says is we will go back to the company that you purchased it from, and we would look at how the policy is performing. Is it performing better than we thought? Is it performing worse than what you thought? And then we'd figure out a solution. This way, if we want to keep it, we can figure out what needs to be done to keep it. If you want to roll it out, we can figure out what's the best way to roll it out. Does that answer your question, Dan?
It does.
Okay, next.
Yeah, okay.
I feel like we're having our own conversation.
Well, it's just us speaking. I'm listening.
Okay, consider the value to your loved one. So annual income employee. Oh, so here's something I find that employer provided benefits. Unfortunately for the world today, a lot of people are furloughed and a lot of people have lost their benefits. Insurance is one of them. When you leave your employment, you lose your coverage. You don't take your life insurance with you. I'm on a lot of the advisory boards and I do work with the New York Times and AMC networks. And when people lose their job, they send me an email telling me that this person's available to be contacted to see if they want to get additional coverage. It doesn't come with you. So there are certain things. So if you find yourself on the outside looking in, then you should do something because you're losing your coverage. For all of you who have great jobs and you're happily working and stuff like that, you should not leave your coverage solely for your employer. You should always have your own coverage. So I'm in the business. Even when I was a lawyer, I had my own coverage because I didn't want some company controlling it. I wanted to know that if I left my employment, I wouldn't have to take another physical. I wouldn't have to say, may I have my coverage. So most companies give you 1 times your salary. That's clearly not enough. Why? Because is that enough to pay off your debt? Is it enough to send your kids to college? And is it enough to replace your income? If it's not, rather than supplementing it through your employer, you're much better off taking your own plan. Why? One, it's portable, right? You take your plan, you leave your company, it comes with you. Two, you can name it, you can name the owner and beneficiaries as a trust. So if you decided that you wanted to shelter it from the government, you could do that. And the other thing is also, you could convert it to a permanent plan if you wanted to. You could change it to a permanent plan. And the other thing also is, typically it's cheaper. Let's say Dan and I work for the same company and he's completely insurable, I'm completely uninsurable. We're the same age, but he's healthy, I'm not. Basically, he and I are going to pay the same rate. Why? We're the same age, we're the same gender. He's subsidizing me. So if we're paying $100 a month, my coverage would have been $300, his coverage would have been $50, he's subsidizing me. So if you're healthy, you shouldn't supplement it in a plan where you're not getting credit for your being healthy. You want to get credit for being healthy by applying for your outside plan. So that woman I told you who I'm contacting with who had cancer, when she took out her plan 18 years ago, she was in elite category. We could go back and we could convert her plan to elite classification, even though she's now uninsurable. So to have only your coverages through your job is only convenient. It's not in your best interest.
And let me just to comment really quickly, just as a side note for people raising their hands and asking if we can take questions, we will. We're just going to wait till the end of the presentation. So I'll make sure to tell you to ask in the Q&A section and we'll answer. So
thank you, Dan. Okay, next. Okay, so an employer-provided life insurance benefit isn't enough. We just discussed it's not portable, may provide only limited benefits. Employer plans may change, reduce, or dropped entirely. Over the life of my experience, I have seen the AEICPA drop their disability coverage. I've seen medical groups drop their coverages. Happens all the time. You know, if you have an individual plan, it's guaranteed renewable, guaranteed convertible. It can't be terminated. Only you could terminate. So let's say you did a plan for 20 years and after 10 years, you decide you don't need that anymore, cancel it, but they can't cancel you. If you decide that you don't need the full million, but maybe you need $500,000, lower it to $500,000. You can make changes. They can't make changes to you. So the advantage of that is you control the situation. You control the dialogue, not the other way around. So it's convenient to do the plan, but it's not the same thing if you want to do the right. It's all a matter of being efficient with your assets, being efficient with your investments, and being efficient with your insurance. If you're paying money, what's the best opportunity cost for that dollar? What's the place where the money, where your insurance could go the longest way? Okay, Dave, next. So if you purchase life insurance on your own, you can supplement what life insurance you need. You get through your employer. You own it and can take it with you when you leave your job. You have more choices on what you can purchase. So any insurance through a company is typically term insurance, not permanent. So if your goal is to have some form of permanent coverage, then certainly the coverage through your job will not do it. So it all depends on when you want. So let's look at it this way. So let's say that you have a young family and you have $1 million coverage. And when you're 70, you don't necessarily want to go to zero. Or when you're 65, you don't want to go to zero, but you don't need $1 million. So a lot of times we'll do $1 million for 20 years. And then we'll do 100,000 permanent. So therefore at 65 or 60 or 70, you don't go to zero, you go to whatever the reduced whole life would be. It's just the way of planning. Okay, Dan. Okay, what else can life insurance do? For those of you who have a company with a partner, that's called a buy-sell agreement. So Dan and I are partners, we're in a law firm together, I die, how is my spouse going to get my share of the ownership? How's it going to come out? So it could either come out of current income or it comes out through life insurance. A buy-sell agreement is a really important part for businesses because it protects the other person and their family. You want to make sure that your interest is protected. So what the company does is ABC law firm will go out and buy a plan. I'm the insured of one policy, Dan's the insured of the other, and the beneficiary is the business. I die, the money goes to the business uses the money to buy out my share, Dan owns the practice on his own, and my spouse gets the money.
And it's important to remember that this benefits not just the person's family who passes away, it benefits the other business owner as well. You know, you can imagine if Stephen and I are perhaps plumbers, you know, if something happens to me and I pass away, my wife becomes a 50% owner in that business. Well, if my wife doesn't want to do plumbing, you know, Stephen's in a bad position because he's going to have to do more of the work, clearly. So, you know, buy-sell agreements tend to benefit both parties. And I think the second party is the one that gets missed in a lot of these agreements. Everyone's just thinking the deceased owner. No, it's also the remaining owner, of course.
But not only that, Dan, so in your scenario, so every single week, my wife's going to knock on Dan's business door and say, could I have Steve's share of the income? Every week. So for the first 2 months, you might be really nice about it. Next 3 months, you might be okay about it. Afterwards, you're going to say, how long am I going to keep paying her 50% of the profits?
I'm a lawyer. I never hear the nice side of this. It's usually over instantly. 2
Right?
weeks is being generous.
Well, this is what happens. And then the other thing is, let's say those of you who have a business and you have a really key person, you have a really smart person who works for you, you have a really dedicated person where if that person left, it would leave you in a bind. How about writing life insurance on that person? And how about saying to the person, look, I really like you. If you died, I'm going to make sure your family gets paid $1 million. If you stay at the end of 10 years or 12 years or 15 years, I can have a life insurance with cash value that I'm going to give to you that you could use for your retirement. You know, you're keeping people there. It's golden handcuffs. So a key person, basically, you could do life insurance so that if they leave, you're protected. If they leave, their family's protected. Or you could create a scenario where you try to have the person stay with you as long as possible. So you say to them, look, if you stay after 10 years, you're going to have $100,000 of cash value that I created for you through the use of a life insurance. But if you leave earlier than 10 years, it goes back to me. It's a way to keep people there. So people want to be recognized. People want to be appreciated. And one way to do it is to basically, it's got to be a double win situation. They win because they're with you. You win because they're there. And it's kind of like a winning strategy. Okay. So what else can life insurance do? So even though currently the amount of assets needed to generate a federal estate tax is huge, I would ask people if they think that this is how it's going to stay forever and ever and ever. The answer is no. Every 6, 8, 10 years, the federal estate taxes are changed. The amounts go higher, it goes lower, it goes anywhere. Let's assume you have a permanent plan and you turn around and you say, my kids are grown, we don't need the coverage anymore. And you do your planning with Dan or with a financial planner like us, and we turn around and we do a projection. We're going to say between federal and state, you're going to owe $1.3 million to the government. You're going to say, I owe $1.3 million for what? Because anytime you have incidents of ownership in an asset that passes to your heirs other than your spouse, there's estate taxes. So if you have a life insurance policy for $1 million, why don't you just use that to pay for your estate taxes? Did the policy cost you $1 million to create? No. The policy probably cost $10,000 a year for 10 years. It cost $150 to create a tax-free benefit of $1 million. So a lot of times Your reasons for the life insurance may change, but there still might be a need for insurance. Again, it's only recently to have people spoken about Social Security, not realizing that one of their Social Security benefits will decrease, will eliminate. So the nice thing about the life insurance, it's kind of like pennies on the dollars. You pay 10,000 a year, 100,000 over the lifetime for $1 million benefit, and now you created a fund that could be used to pay estate taxes. It could be used to send grandkids to college. It could be used for anything.
And it would be a dereliction of my duty not to chime in here. I can't tell you how often I have either families who own businesses or who are perhaps heavy in real estate. You know, they own several pieces of rental real estate. You know, they only have 9 months to come up with that cash to pay the IRS. So, or the state of New York, for example. If you're assuming that they're going to be able to sell a building within 9 months, what if someone died just a few months ago? You think they're going to be able to come up with that money within 9 months of the person passing away under this current crisis? The answer, of course, is no.
Right.
Life insurance becomes the fund to pay that tax bill, which is due 9 months after the date of death.
And do you think you'll get fair market value within 9 months after the person dies? No.
Never, especially once they read who passed away recently and they're able to figure out that, you know, the wealthy person who passed away was actually only wealthy because they owned a bunch of real estate, not any cash.
So we're doing this seminar this way to think a little bit outside the box, because everybody's different, everybody has different needs, but sometimes we lose sight of why people do life insurance and what are the advantages of having life insurance, and that the advantages of having it often changes as people get older. Okay, Dan, next. So there's a type of plan now that's a combination. Everybody knows long-term care. Long-term care basically says, we're going to provide you benefits if you have nursing home care, if you need home health care, or you need assisted living care. And people are buying policies. The problem with the older policies are a couple. One is, for those of you who have it, the premiums often increase. It's not like a whole life policy where the premiums are locked in. With a long-term care, the traditional types, premiums increase, policies are sold. You don't have the safeguards that other ones. So there are people who premiums have quadrupled over the past 20 years. Or people die without using it. You have a policy, you know, this happened to my next door neighbor. They had a plan for maybe 7, 8 years. She got cancer, God forbid, and unfortunately, and died. And she never even got a claim paid. So the old ways of doing the long-term care may be a little bit obsolete today. Next slide, Dan. So you'll see that the costs are really high. You'll see the nursing home, the monthly cost is $6,600, assisted living, it's that, adult care. Dan, you can put the last slide on while I'm talking, the very last.
Oops, sorry.
One more.
Oops.
Oh, okay,
Not
yeah.
that one. Yeah. All right, there we go.
Okay, so basically the plans today, what they're doing is they're combining a combination of life insurance and long-term care and cash value. They're called a blended plan. The advantages of that is the premiums are guaranteed, they do not go up. If you decide down the road that you don't need the plan anymore, you don't want the long-term care, you don't need the life insurance, you could pull your full premium out plus some gains. And if you die, let's say you're like my next door neighbor and dies, then you get the death benefit. So one plan gives you the advantage of having 3 scenarios. Dan, were you going to say something?
I was going to say, with the new Medicaid laws coming down, I mean, it used to be that I could help someone qualify for Medicaid after 1 month of transferring SS assets for home care. That's going to be changing to 30 months. So people who don't have some form of long-term care coverage but have assets, there's going to be a lot of risk. There's going to be a lot of private paying coming out of your pocket for more or less 2.5 years. So this is the game in town to protect wealth for people who are getting older and may become disabled.
and this is the big unknown. The two big unknowns that we deal with financial planning is one, healthcare and long-term care. What to do. When you figure out your plan, things can go wrong. Like, what are the things that go wrong? If you get really sick and need the care, how will that leave your spouse? How will that leave the money you leave behind? Will it be enough for the spouse to live? So oftentimes people want to try to, you know, get the right results, but they don't know the right approach. They don't know how to do it. And the nice thing about a hybrid plan, it gives you a combination, and it gives you the ability that if, you know, you're not stuck into something you don't need. If you decide, you know, and look at it this way, your money in the bank today is very low interest. It's not paying a lot. So if you have money in the bank or money in a hybrid long-term care, you're basically getting almost the same returns. So with the hybrid, if you die prematurely, there's a death benefit that's tax-free. Or if you need care, then you have money set aside to pay for your care. So the advantages of that type is much greater than going bare, much greater than not having any. So, are there any questions, Dan?
Yeah, I'm going to open up the Q&A session. I have some questions on the chat, and I'm going to let people answer. Where you go to Q&A is if you go to your Zoom screen. It's basically the bar that's right by the green and red bar on your screen. You'll see the letters Q and A, so you can ask questions there. I'll also answer a question or two on the chat. I'll just share a personal story really quickly. You know, my father was a brain surgeon. For those of you who don't know, my father passed away when I was 4, when he was 35. Here was an individual that was conceivably going to, you know, make millions, potentially tens of millions of dollars in his lifetime. He actually practiced brain surgery for less than 2 years of his life. He died, and this is someone, again, who probably should have been insured for millions of dollars. He had $100,000 of life insurance when he died.
Wow.
I just got very fortunate. My mother had a good career and was able to provide for her children. So, you know, I just can't tell people enough when Stephen said that, you know, people never complain when it's too much money. What a surprise. People never complain when there is too much money. So that is definitely true. And I would recommend that people definitely consider reassessing their current life insurance needs. Okay, so I'm going to start answering questions. I have a question from Philip. If we purchase the hybrid long-term care policy, what is included?
So, Philip, that's a great question. Basically, everything that a traditional plan would include. You'd have your long-term care, you'd have your stay in a nursing home, assisted living, or home health care. It basically provides the same ADLs, activities of daily living, the same triggers to generate a claim, and it provides the same benefits. Typically, a percentage of the death benefit is used for your long-term care benefit. So how much you receive is a factor of how much death benefit you purchased. But there's no difference as far as what's included and what's not included.
So I saw 2 hands raised. I am going to allow these 2 people to talk. I'm going to give them a heads up. There's Shelley E, who I'm going to allow a talk, and Elizabeth F. So I'm going to start with Shelley E because I believe she came in first. I'm going to hit allowed to talk, Shelley. If you'd like to ask a question, that's fine. Be ready. If I don't hear from you, we'll go to Elizabeth F, and then we'll go to the questions that are being posted. So Shelley, I'm going to put you on now. And hopefully you can speak, Shelley. Are you there?
Hello, do you hear me? Hello?
We can
Yes.
hear you,
Hi.
Shelley.
Oh, hi, Mr. Dan. Hi, Mr. Steve.
Hi.
I don't have any children. Do I need life insurance?
Great question. So do you have anybody dependent upon you, a parent, any relative, any dependent upon your income?
You a while ago before this crisis, and I have a niece and I have a nephew. And like I said, I'm still working in the Board of Education, and everything should go to them and my sister. I do have a father, thank God he's still around, but I did put my beneficiary for my sister, my niece, and JP. So, do I need life insurance though?
So, Stephen, I'll let you answer that question.
Thank you, Dan. I would tend to think not. You look at what you're providing to your niece and your dad or whoever it may be. If your assets are enough where you feel comfortable with what they have, then you absolutely do not need life insurance. If you don't have enough assets where you think it may not last, then you might. But judging from what you're telling me now, working for the Board of Ed, I think you're fine and do not need life insurance. It doesn't mean you may not need the long-term care, but that could be a different issue. Okay, Dan.
I'm going to bring on Elizabeth F. We'll see if you're going to be there. And you've been unmuted, Elizabeth. Or you asked a question. I unmuted you, but I saw that you asked the question. And the question is, do I need life insurance? I'm retired, late 70s, female, no debt, modest lifestyle, reasonably good health, no children, no dependents. Should I get insurance to cover cremation expenses? Elizabeth. So basically, should people be talking about life insurance for end of life planning? I can pick this up partially. And Stephen, feel free to tag on to this as well. You know, usually for end of life specifically, when there's a little bit of money that you require, because most funerals are going to be about $10,000 to $15,000. If you already have a plot, if you're getting cremated, it should be less. You still probably want to have a ceremony. You know, the answer is you probably don't need it. However, the bigger issue is if you don't have any liquid assets and you don't have family members that have a lot of liquid assets, life insurance, at least a small policy, is probably a good thing, because that way someone gets the money relatively quickly. You know, the money in your bank account, unless you name a beneficiary, is locked up. Your house, you can't have your house sold so that you can pay an attorney to begin probating your estate. You have to probate your estate before then. So at least a small life insurance policy can make sense, and conceivably more. And Stephen, I don't know if you want to tack on any answer to that question.
No, Dan, that was perfect. I mean, it really depends on your unique circumstance. Typically, when you're in that situation, you may not have a need for a large policy, but for liquidity purposes, for getting things done immediately, it can be advantageous at some point.
Great. I have a question from Philip K. Hi, Dan. Is Stephen licensed in New Jersey? What is the best age for long-term care? 60, 65? Now?
Okay,
I know Philip, so I'm not going to rat out how old he is right now, but that is a good question.
So I am licensed in New Jersey, and the typical age that most people look at long-term care is mid-50s to 60s. So it really depends on your net worth and which type of plan you're going for. But typically, I would say between 50 and 65 is the range.
Elizabeth had one more question. What's our opinion on Colonial Penn dollars per month? Never goes up, never can be canceled. So I don't know if Stephen's allowed to answer a question about specific companies, but I'll let him make something up in a little.
I can. I mean, it's basically a graded plan where, you have to live a certain time for the whole death benefit to be included. So I think any type of coverage you get is better than not having it. And with them, your premium stays the same, but if you died within a certain period of time, you'll get a fraction of the death benefit, and it would change accordingly.
Got it. And I just wanted to also add, we spoke a lot about life insurance being income tax free. We didn't really get so much in the thick of the woods regarding estate taxes, other than to say that life insurance good when it comes to paying for estate taxes. Just because you own life insurance and it's avoiding income taxes, for people who have slightly higher net worths or may move to a state that has a very low threshold for state estate taxes, you really need to own that life insurance in an irrevocable trust. And it has to be a very specific type of irrevocable trust specifically made for estate tax savings, and often with life insurance. Again, another discussion, but one I would love to have someday. But we're getting close to the end of our time. I want to thank Stephen. I want to thank everyone who's on today. Again, slowly but surely, I am getting the power beneath my wings handle these webinars. I'll ask one final question and then we'll go. And this is by Shelley E. Do I need to have someone in my will for my pets? If so, can I change items that I had written in a will before this crisis arose, let's say? And the answer is, I'll just have to talk to you offline because we've run out of time. Thank you, Stephen, for joining us. I appreciate it. If people have questions, you have Stephen's information here. And of course, we will see you in the near future. Thank you, everyone, for joining us.
Thanks, Dan.